Good evening and welcome, everyone. It's always nice to see familiar faces of clients and friends, but for those of you who are new clients or guests of ours this evening who I have not yet met, my name is David Sung, and on behalf of everyone at Nicola Wealth Management, I'd like to welcome you to our fall event, Real Assets, Real Returns. Let's jump right in. First off, what are real assets? This is the Investopedia.com definition of real assets, but here's what you really need to know. Real assets are tangible investments. They're investments that you can touch with your hands or see with your eyes. They're not stock ticker symbols or pieces of paper that have been financially engineered into investments. So consequently, real assets have additional tangible benefits, such as not necessarily being correlated to the stock market, providing an additional form of inflation protection, and historically, providing better long-term returns with less volatility than the stock market. So by focusing on real assets this evening, it's our goal to give all of you a deeper insight into what we mean at Nicola Wealth Management when we say our focus is on extensive diversification. Now, luck has it for us tonight, and timing was perfect, that in today's National Post, there was an article on real assets describing just that, how real assets can provide additional diversification and reduced volatility for your portfolios. And a copy of this article was placed on each of your chairs this evening as you came in. Now, this is a slide that I've shared and we've shared with many of you a few times before. What you're looking at here is the typical retail balanced mutual fund or traditional balanced portfolio, which consists really of two asset classes, publicly traded stocks and publicly traded fixed income. And over the past 10 years, from 2004 to the end of 2013, that's been the 10-year average annualized rate of return, 3.99%, which is just a little bit more than inflation. Now, our definition and our view of what a diversified balanced portfolio is obviously looks much different. But this time around, let me give you an actual specific example. What you're looking at here is the actual asset allocation of our next speaker's personal portfolio. And the number there that you're looking at is his 10-year average annualized rate of return. So that's over a relatively decent long-term period of time. Now, over the shorter term, most recently, I'm sure a number of you have noticed the recent volatility in the global stock markets. And more specifically, I'm sure Canada has not been immune to this. And from September the 1st of this year until October the 20th, which is just a little over a month and a half or 50 days, the Canadian stock market dropped 9% over that period of time, while this portfolio actually increased just about 1%. So when we say that diversification is what we focus on and making sure that it's broad, that's exactly what we mean. Now, given the number of pieces that you're looking at on the pie in the short period of time that we have this evening, we certainly don't have the time to focus on every area, so we're going to focus on two specific areas of the pie, and that's real estate and private equity, both of which can be classified as real assets. Helping us walk through these topics this evening is a trio of speakers. Our first speaker this evening, our CEO, John Nicola. John's going to focus on real assets and giving us a broader definition of how that fits into our diversified approach to investing. And following John will be our special guest this evening, coming all the way from Toronto, Eric Burke. Eric is the managing partner of TorQuest, one of our private equity partners. Now, Eric's going to give us what I would call a peek behind the curtain and give us a little bit more insight into how a private equity deal comes together and how that specific expertise can help add to an investor's bottom line. And last but not least is our company's real estate managing director and chief investment officer of our real estate group, Wayman Crosby. Wayman's going to focus on and share some stories with us on how effectively managing real estate assets can add to an investor's and a real estate investor's bottom line. So if you're still thinking and wondering why real assets, I mean, beyond diversification and reduced volatility, where's the real opportunity? Let me share with everyone one last example. Infrastructure. Infrastructure is a real asset, and it often relies on private equity or private money. Now, every 4 years, the ASCE, which is the American Society of Civil Engineers, comes out with a report card. And their report card grades the United States infrastructure assets. Examples include bridges, dams, roads, and rail lines. And of the 84,000 dams currently in the United States, the average age is 52 years old, and with many of those dams now being marked as being in a high hazardous state. So when the ASCE adds up all the report cards on each of these assets, the American infrastructure grade point average comes in at a D+. Now, in order to bring this up to a respectable passing grade of B, it's estimated that the United States is going to need to invest $3.6 trillion by the year 2020. And the ASCE also estimated in their report last year that of this, due to the aging infrastructure and the poor state of these assets, it's going to cost American businesses close to $1.2 trillion by 2020. So clearly there is a massive need for capital in this area, which means there's an opportunity to add assets such as infrastructure and other real assets to a diversified portfolio. So with that, I'd like to welcome John Nicola to the stage, who can share with us just exactly how all of us can begin going about doing exactly that. John?